You're missing the biggest wealth building opportunity of your lifetime right now. And listen, I don't like to use fear like this, but this is the only thing that works to get the message out to you, to get your attention away from the content that this platform wants to push. You know, the stuff designed to keep you spending, because the more you spend, the more money they make. So what I need you to do right now is I need you to save this video. I need you to comment that you want to stay on Rich Talk. This way the algorithm can start pushing you more content to help you make money instead of taking it out of your life. Now, I went from $40,000 in debt to millionaire at 30 by learning how money works. And in this video, I'm going to teach you what's happening in the stock market right now, which is the greatest wealth building tool available to you, and the economy, so you can start making passive income and get really rich. Because I didn't always have a beautiful life like this, okay? But I do now, and I want this for you. Now, the way that you're going to get really rich is not only by understanding how the stock market works, but understanding how to spot opportunities so you can make more money with less. And now I'm going to let you in on a little secret. The economy and the stock market, they do not move at the same time. The economy, it lags. We don't find out that we're in a recession until we're already in a recession. The data like job losses, company earnings, GDP, that takes time to show up. If you're like, Nicole, what the fuck is GDP? It's just the total value of everything a country produces. And when it drops, it's a key sign that the economy is shrinking. Now the market, it leads. It moves before the economy recovers because investors aren't reacting to what's happening today. They are positioning for what they believe will happen in 6 to 12 months from now. Think of it like this, okay? If the economy is a mirror, it's showing you what already happened. The stock market is like a weather forecast. It's forward looking. It might not always be right, but it's trying to predict what's going to happen next. So the market usually drops before the recession begins, and it usually starts to recover before the recession ends. Let's take 2008 as an example, okay? The financial crisis, it hit hard. Stock market bottomed March 2009, but the recession didn't officially end until June. In those 3 months, the market surged 40%. It went up 40% in 3 months. While the headlines were still gloom and doom, the market had already moved on. On average, the stock market bottoms 6 to 9 months before a recession ends. So if you are waiting for things to feel safe, for the headlines to be like, yay, everything's good again, you've already missed it. So what are you gonna do? How are you gonna take advantage of this? You are going to, number one, open up a self-directed investing account, okay, with a low or no fee brokerage. In Canada, I like Questrade and Wealthsimple. In the US, I like Vanguard and Fidelity. Then you are going to pick a globally diversified ETF. You can do this simply with a target date index fund, an asset allocation fund, or you can build a 3-fund portfolio that gives you total US market exposure, international exposure, and some bond exposure. And if you're like me and you love real estate but don't want to manage properties, you can add in some REITs. Step 3, you're going to decide how much you can add in every month. Let's say you're like, okay, I can do $250 a month. Then you're going to stay consistent for the long term. Let's say you do that $250 a month. That would be about $90,000 of your own money over 30 years with a 10% return, which is the average return of the stock market over the last 100 years. $90,000 of your own money would have turned into over $500,000. Then you are going to automate that so that happens every month without you having to think about it, okay? You are going to pay your future self first. You're not going to try to time the market to pull your stocks out when things look bad, because that's how you lock in your losses. That's how you lose money. Because listen to these stats, okay? If you tried to time the market and you missed just the 10 best days in the market over the last 20 years, your returns would have been cut in half. And if you missed the 20 best days, okay, you would have lost 80% of your potential growth. The kicker is that the best days in the market typically happen around some of the worst. Okay, hear me when I say this. If you pull out during a drop, you miss the recovery. But here's the nuance, okay? Consistency is key, but downturns are also opportunities. So if you see the market drop by 10% or more, maybe you decide to put more in. That's my strategy. If I see a drop by 10% or more, I add more money. And if I see a drop by 20% or more and I have extra cash on the sidelines, I'm all in. Because when prices fall, every dollar you add in buys more shares. You're buying more with less. The stock market is on sale. And now here's what I really need you to understand. If you're not investing, you're not just missing out, you're falling behind. Every dollar you choose not to put to work is losing value due to inflation. Every dollar you wait to invest until you're older is another dollar that you're going to have to invest to make up for it, because money you save and invest in your 20s is worth twice as much as your 30s due to compound interest. The longer you wait, the more money you have to put in to end up with the same result. Now, if you want help building a long-term investing strategy that works in any market, okay, take my free How to Get Rich in a Recession Masterclass. Grab your spot right now, link in bio.